I'm pleased and honored to welcome the Chief Investment Officer of IronHold Capital, Siddharth Singhai. IronHold Capital's global deep value strategy employs the true philosophy of value investing. The fund selects high quality but undervalued companies in the US and in India that have the potential to outperform the market in the medium to long term. So without further ado, I introduce Mr. Singhai. Sid, we are happy to have you and excited to learn more.
Well, pleasure to be here, and I would like to thank you for inviting me, and also Professor Wayne as well.
Absolutely. Thanks for coming.
So I'm going to be sharing the presentation. Could you just allow me to share, Professor Durr? Perfect. Thank you.
So the presentation Andrew is pulling up in a second is on value investing. And some of you might be aware of what value investing is. Some of you might not be. This might be an introduction for you. We'll go over these things. What is investing? What is value investing? Why you should invest for the long term. Qualities that you need to be a value investor. How do you actually go about investing in a nutshell? The most important principle, margin of safety. And I'll run you through an example. So let's begin with the first slide, Andrew. So essentially investing is making money from money. You take capital, you find an asset that you like, which could be stocks, real estate, gold, silver, any of the commodities, or it could be valuable art, right? Or luxury automobiles, which are also rare, that will hold value or appreciate in value over time. And you can invest your money in these assets with the hope of growing it, right? That is sort of investing in a very simple manner, if you were to put it that way. But the way we define investing, and as what we believe is a better way to go about it, is in investing, a successful investment is one that protects your principal and then gives you an adequate return over it. So if you were to read The Intelligent Investor by the late great Ben Graham, that's the definition you'll find there. So when we think about it, well, how do we protect the principal? And what will allow us to generate alpha or market-beating returns? Then value investing immediately pops up, because if you look at history, if you look at some of the greatest investors in history, Mr. Seth Klarman, Mr. Greenblatt, and Mr. Warren Buffett himself, they all follow the same principles, and there are a bunch of new investors, modern investors, which do the same as well. So it has a proven track record, value investment strategy. Though there are ways to go about value investing, but the central thesis is you assume yourself as the owner of any stock that you own, or the underlying business rather. So if you were to own the stock Amazon, right, you're not really buying a ticker that goes up and down in price every day. You have essentially bought fractional ownership of that business, which is in a very simplified manner. You are now a partner with Jeff Bezos, although you don't get to control what happens, right? You are leaving your business to him to run it. And if you think about it, let's say you had a family business, right?
Okay.
Like a restaurant, something like that. You wouldn't think about selling it every day, right? You would sell it maybe when it becomes just unattractive in general, right? Permanently. But you would think like a business owner then. And stocks are no different. And in addition, so that's one of the tenets. The other important one is that we try and, first of all, value these businesses and we try and buy them for a lot less, which is the second central thesis, if you would want to call it. And how can we do that? So if you go to the next slide, Andrew. So the market, how should you think about stock prices and the market in general? Market really involves, everybody in the US is investing in public equities. For our example, they're all trying to figure out what anything is worth, right? So people in the market, there are buyers and sellers. They're both trying to figure out what is Amazon, the stock, worth, or any stock in the market is worth. And they do that based on their own expectations of the future. Now, when we say that the market is efficient, we assume all of those people are rational participants. They know all the facts. They don't behave emotionally. And so the prices that are set in the market are pretty much efficient, or they reflect the underlying business perfectly. That is something we don't believe, right? That is the efficient market hypothesis. And we believe that the market in the short term is, it's almost random. It's driven by wild forces. And those forces are driven by emotions. So in the short run, stock would double or triple while the business has not, right? You saw that probably with GameStop. Stock was irrationally overpriced, and then it has declined since. So in the short run, we don't really care about the short run. First of all, it is pretty much impossible to say what a stock will do. That is because of the wild forces governing the supply and demand of these things. In the long run, however, efficient market hypothesis has to hold true. If you find a house that's giving you 50% return, that's not always going to give you 50%, right? Eventually, the price will move so that you get the average return, which is, in our case, in the stock market, it's around 10%. So anytime you find opportunities that will give you better than 10%, you have found something that is either not efficiently priced, or you are wrong that it is going to give you greater than 10%. So every business has an intrinsic value, the blue line, as you can see. That is nothing but the discounted cash flows, right, that will produce over its lifetime. And if you can figure that out, then all you have to see is where is this company trading at. So as you can see, underpriced, right? Market is maybe emotional for the short run. It will give you opportunity to buy that company for a huge discount to that value. And this is what Mr. Buffett has been doing, though he has made some modifications we'll see later. But that is essentially what value investors do. They come in when the stock is underpriced, they buy it, and they wait for market efficiency to play out. Over the long term, stock price is going to reflect quality of the business or performance of the business, right? And I would suggest if you can, on your own, check out stock prices over time, right? 5, 10, 15 years. Check out earnings growth and dividends, right, for each of the companies. What you will find is over time, the return of the stock is no different than the earnings growth and the dividend yield. Or, they're doing share repurchases, you can add that in. So long term, we care about what happens to the business, not the stock price. They'll be the same. Go to the next slide, Andrew. Now, this is something relevant for everybody here, since you guys are all young and you have a number of years ahead of you. Compounding. And I won't get into too much because it's a whole topic in itself. Compounding is one of the reasons why we invest for the long term, right? Now, this is a real world example. If you were to buy a local S&P 500 index and you were to put You started out with $1,000, and every month you invested another $2,000 for 25 years. Your money would grow into something close to 1.5 million over that period of time. Now, you did not have to pick stocks. Actively, you didn't do anything. You just put aside a little bit of money every month and you let it grow. And that's the power of compound. So how is this relevant to you guys? Because you guys are all young and you don't have to have a lot of money to get started in the market. What you need is time in the market. And this is an example of that. Can you go to the next slide, Andrew? And why only long-term makes sense? Because one, almost nobody can predict what's going to happen in the short term. And two, in the long run, as long as the underlying economy is doing well, in this case, the US, the index will just track that, right? So this is the S&P 500 index over roughly 60 years from Jan 57 to Jan 2019. And you can see a lot of things happened during that time period, right? From Cuban Missile Crisis to peso crisis to the 87 stock market crash, and then the unfortunate World Trade Center attacks, the dot-com bubble, that burst around the same time. And then you had the 2008 Great Recession, and then what probably is a slightly older graph, it doesn't show COVID, right? That also happened. And as you can see, the market did react to all of that, right? Because the market is driven by emotions. But if you were invested throughout, you did well. And this is just the index. Now, why did it do so well? Because the index will just track what the United States as a nation will do over time. And because we live in a capitalistic society where people are incentivized to go out there and be productive and earn a living by doing so, as long as the US does well, stock markets should do well, right, over time. But there are exceptions. If the index is overheated, which I believe it is right now, then you would have to be a little bit careful, right? But long term, again, much like stock prices track businesses, indexes will track the performance of the nation. So that's why we invest for the long term. Andrew, can you go to the next slide? And now, what is the psychology of a value investor? We really need four things. You need emotional stability, you need patience, you need filters that allow you to say no to everything, almost everything. And you have to think in terms of bets. So if you go to the next slide, Andrew. Emotional stability and patience. Stock market is random in the short term, and it will test your patience. Any stock you'll buy over its duration is very likely to go down by 20, 30, 40%, right? Then your convictions will be tested. Is this decline permanent or temporary? And the only way to really deal with that is to know what you own. If you know the intrinsic value of a business and you're very certain that that has not been affected, then this is actually a great buying opportunity, right? You get to buy this business for cheap. But for that, you need emotional stability. You cannot be driven by the news or what you read in the papers or even other experts. You have to have your own thesis, and that should be based on actual facts. So you have to keep the emotions out. In addition, you have to be patient. To make money in the market, it's advised that you invest for the long term, right? If you buy a great business, as you can see, these are some of the greatest businesses that have ever existed, Berkshire Hathaway and Amazon. Over time, they've done exceptionally well. But if you were holding on to these businesses, you would see periods where they took a hit, right? And so if you were emotionally affected and then you were forced to sell, yeah, that you cannot do. Yeah, that will not give you a great investment result. So emotional stability and patience. Andrew, if you go to the next slide. And then these are qualities that are more related to how do you actually go about investing. One is you have to think in bets. Second, as I already mentioned, you have to say no to almost everything. Third, you have to have a margin of safety. Go to the next slide, Andrew. Thinking in bets. Now, everybody takes risks all the time. We all take risks in our, day-to-day life, but we weigh it against the benefit, right? We do it subconsciously. These are all the unfortunate things that could happen to a person, right? You could get attacked by a shark, get hit by an asteroid, or get struck by lightning, or car accidents. Those are more common, fortunately. But you don't stop going to the beach. You don't stop driving cars, and it's not advisable to hang out in the rain. But the probability is so low that you accept that risk, right? If you flip that and you think about investing, you want just that. You want something that is minimal amount of downside and a huge upside. Logically, right? That makes sense. But a lot of times in investing, people get greedy, people get irrational, and they are willing to take huge risks for huge rewards. And we're seeing that. Actually, this is a great time to witness that. People are speculating, people are investing in things they don't understand completely, may not have a bright financial future. And they are letting the irrational part of the brain take over, and they have sort of thrown this concept out almost. Because remember, investing is, in a nutshell, you have to protect the principal, right? And if you're taking a huge risk, that by definition means that you're not probably protecting the principal. So you have to think in bets. Go to the next slide, Andrew. Second is you have to have filters. There are thousands of stocks out there, and you should be within a few seconds be able to tell if this is something you want to pursue. Think about marriage, right? You have millions of opportunities out there, literally, but you have specific set of maybe requirements, filters, characteristics that you want. And if you don't have a filter for how quickly you can sort through those opportunities, it's impossible for you to, chase every opportunity and figure out if this is worth your time or not. So filters allow you to really focus your efforts on the few opportunities that make sense, right? And then you can further investigate if they're worth it or not. And I'll get into what those filters are once we get to the example. The last one is margin of safety. So if you notice elevators around you, they have a personal limit, right? 8, 12, 16, 32. But, and I wouldn't suggest you test it, let's say 12 people get in on an elevator with the 8 people limit. It's not like it's going to break down completely, right? When the engineers were designing the elevator, they knew human beings are not perfect. They will make mistakes. And so they had built in a factor of safety. And it's the same case with bridges, right? They do the same thing. They will make the bridge twice as strong. Maybe something weird happens, right? Maybe there are strong winds. Maybe there's some crack. You just don't know, right? So what you do is you double down on the safety. And that's what we do with our investments as well. When you buy a stock, if there's no margin of safety, because nobody knows with absolute certainty what's going to happen to a company, you are taking on a risk, right? Margin of safety protects you from uncertainty. or your own inadequacies as an analyst. So in any investment, if you buy it for cheap, essentially you are not only making money when it achieves efficiency, but you also are protecting your principal. Buy a stock for 30% cheap, the company could decline permanently by 30%, your principal is still protected, right? So you always need some margin of safety in your principal. And I think that's probably the most important thing you have to keep in mind. Now, how does it all come together? Lear Corporation, and full disclosure, we may or may not own positions in the future. We own positions right now. I personally do. So this should not be construed as investment advice. It's just an example. I was talking about filters, right? Filters that we use are, I want a high quality business with a very strong balance sheet, and I want it for cheap. And those are the three filters that you see, right? ROIC, that's really, in layman's terms, it's just a metric that tracks quality of a business. Average business earns return on invested capital close to its cost of capital, or, which is roughly around 10 to 15%. So if you're buying a business that earns 40% ROIC, you are looking at something that's high quality. What quality means, that's a topic in itself. But that's one. Second, we look at the balance sheet. We don't want companies that are leveraged heavily, because bad times are inevitable, right? And when the bad times come, banks want their money back, or they won't lend it to you, or any number of things could happen. So you don't want to rely on capital markets in times of distress. You typically want independence from those markets. And a high quality business with a very safe balance sheet is a great guard against terrible time like the COVID crisis that we just saw. But even after that, we demand even more safety, or margin of safety that I was talking about. We want to buy these businesses with discount to intrinsic value. 33% in this case. What that really means is Lear Corporation, and this is our estimate, obviously, intrinsic value, could fall in value permanently by 30%. It still wouldn't affect our principal. So going back to thinking in bets, the downside is very limited. Probability of it losing money is very low because it's a high quality business. Probability of it going under or being forced into bankruptcy by debt holders is very low because it has virtually no debt and it's easily serviceable. And even if something like that happens and the company loses 30% of its value, which it takes time when you think about, and I'll get into it later, but that's very difficult, though it can happen, absolutely. But even after all those things, if it does lose money, we'll protect it. So Lear, in this case, why is it a high quality business? They work hand in hand with their customers, which could be BMW, Ford, Chrysler, General Motors. They make seats. They're the leading seat provider in the US. They're the cheapest because of economies of scale, and they have huge switching costs because they have to work just in time, which is a philosophy that that was utilized to save up on inventory. Right, as soon as a part comes in, it goes through the assembly line, and you don't store a lot of inventory because that's working capital heavy. So that means that they have to work really closely. If they miss their supply, or they supply seats, even by a few hours, their customers stand to lose a lot of money. So they really have to work in an integrated manner, and that allows them to earn those returns on invested capital that you see here. Now, if you go to the last slide, Andrew, this is, when we valued Lear back in the day, it was trading around 140. Our estimate of intrinsic value was around 240, growing at around 2%. That's why that line is at an angle or slope. And over time, what we expect is, we expect market to be efficient over 2-3 years, right? And if it does achieve efficiency over 2-3 years, our return is a good 85%. And we don't know what's going to happen, though the stock has sort of moved quite a bit. We don't know if it's actually going to approach that intrinsic value soon or not. We can't really say. But if it does, as you guys can see, that vertical distance, right? The stock could really fall by a lot, and our principal will still be protected. So not only do you have a great upside, but your downside is limited in this case. And that's sort of all of our investments, right? And that brings me to the end of the presentation. More than happy to take any of your questions.
I have a question. How do you estimate the intrinsic value of a company?
So fundamentally, you want to know what cash flows will it produce, for how long, and at what rate will they grow, right? If you can figure out those three things, you would know the intrinsic value of a company. And that's true for all businesses, whether simplistic businesses like a bakery or a laundromat, or Amazon or Google. Every business is just worth discounted value of its future cash flows. How exactly we go about it, that's the whole investment process, right? We look at demand, we look at supply or competition, management, and then valuation. And after we have looked at all those factors, we then come up with a range of intrinsic values, because intrinsic value is not a static number, as you saw. It's our estimate. And it will fluctuate slightly. As businesses are imperfect, right? They will fluctuate a little bit. So we try and be very conservative with our assumptions. We won't expect a company, even if it has done really well, let's say it has been growing at 30% for 10 years, we won't expect it to grow at 30% over the next 10, right? That will give us a very high value. We want investments which are no-brainers, which you can just look at them and go, that just doesn't make sense, right? It is way too cheap. And that's the filter thing I was talking about. You would know it immediately when you see a stock like that.
Okay, thank you.
Mm-hmm.
I have a question. With the rise of cryptocurrencies, how are the hedge funds, or how are the hedge funds behaving to it? Are they embracing it? Are they opposing it? What's the position of hedge funds on cryptocurrencies?
Well, so, hedge funds are a business, and, if people want it, they'll sell it to them, right? And so they will embrace it, obviously, as long as it does well. When it's, my opinion is that we don't know what cash flow Bitcoin produces. It doesn't produce any, right? It's sort of like an exotic car. You think it's worth a lot. It will hold its value because there are only 100 or so of it. But it might not be the case, we don't know. I personally don't think it has any value. It doesn't produce any cash flow. It doesn't have, it's not rare. There are many other cryptocurrencies. You guys can create your own cryptocurrencies. So it's not like gold. It was not some alien metal that arrived on Earth that just, is limited. You just can't produce any more of it. So hedge funds will embrace it. I think, as long as it does well. Then I think if it doesn't do well in the future, they might switch. So
All right, thank you.
I have a quick question. Well, thank you for being with us today, first off, but as a value investor and maybe just at Ironhold in general, I think we've seen like a lot of crazy valuations in some specific, sectors like tech, for example. How do you evaluate, some value plays in those particular areas, or do you just completely kind of stray away from them?
well, I would say it depends on two things, right? One is that what is your required rate of return? So I personally want in any investment we make at least 20% IRR, right? So I don't think I can get that by investing in some of these tech stocks. It's not impossible, right? But I also want margin of safety. So when I pay a big price, I have to be right. If I'm wrong and I overpay, I'll just lose money. So the risk reward proposition in tech is not really attractive. So that's one, right? What are your benchmarks? Second is, what do you understand? Now, I personally do understand technology businesses, right? Because I've owned a technology business back in the day. And so they're sort of very different to your traditional manufacturing businesses. You make a product, you sell it to a distributor. That's a typical business, right? You make bearings, or you make valves, or all those things. Those are physical things that you can touch and feel, that you can sell. Software is not like that. Software for tech, tech is sort of not the best word, because tech is also relevant to physical technology, right? I'm talking about bits and bytes. And if you look at something like Microsoft, they don't have a physical product you can see or touch. It exists on your PC, and the economics are different. They can distribute that product for no additional costs. All the investment is upfront, the R&D, and maybe a little bit of post-sales customer service. That's not the case with Ford. They give you the car, and obviously they have to procure the raw materials, go manufacture the car, and then they have to sell it again. So, and they also have to distribute it through dealerships. Microsoft, or any other software business doesn't deal with that. So it is a more attractive type of business because there's no distribution cost. But it's also easier to disrupt. Two people in a room can typically disrupt a lot of tech businesses. Not so the case with at least some of the automobile companies. You need a lot of capital. You need possibly $100 million to even compete with something like a Tesla or Ford Motors. So not everybody can do that. So there are pros and cons. If you can find a software business which cannot be disrupted, that's exceptional, right? So something like ADP, or something like, Amazon to a certain extent is sort of like a hybrid. They have what I would call moat, something that I haven't discussed in this presentation. But whenever you invest in a business, if it doesn't have a competitive positioning that's impenetrable, sort of like a moat around a castle, right? That protects it from, enemies or enemy armies, then eventually that business will not make much money. So if you own a restaurant, you better have some sort of, you either should have exceptional taste, or you own all the real estate or something like that. Because if there are 15 restaurants, beside you, eventually your profits will dissipate. So tech businesses, yes, great businesses if you can figure out what the mode is and if it will endure over time.
Thank you.
So you mentioned the importance of patience in buying and holding investments. But how does that tie into the valuation process? How much time is your company spending analyzing and evaluating a company before you actually execute a trade and become an investor for the long term?
Sure, that's a great question. It kind of changes, right? Sometimes you've been following the industry, so if something comes up in oil and gas, I pretty much know that, very well. And so I don't have to do a lot of research. The great thing in investing is, let's say you started an automobile company, right? Next time, you find some other great company in that industry, you already know what the structure of the industry is, how the competitive forces align. So you don't have to do all that research again. You already know it. All you have to do is, test out the thesis for that particular stock. You know the industry already. So it changes. Sometimes we get no-brainers, right? Stock selling for like 50% cash. Now, if you buy a barbershop for $1 million and you step in and you find $500,000 in the drawers, and it also makes money, the business, it makes 100,000 every year. That's an exceptional business, right? You have stumbled upon something that just, it doesn't have to be exceptional. And you bought it for so cheap, you're just going to make money on it. You just have to make sure that you do make the 100,000. You're not losing 100,000 every year. And that's the only job you have. So when we find no-brainers, it takes very little time, maybe a week, right? Typically, I would say about 2-3 weeks, right? That's the average, I would say.
Sounds good. Thank you.
I just had a question about what do you think the implications of a rising inflation numbers in the coming quarters would be on the market?
So I would have to say, one, I can't really say if there's going to be inflation. That's a macroeconomic factor that, we expected inflation to be there after the Great Recession, but it printed a lot of money then, but it just didn't happen. Nobody expected that you could keep interest rates this low for this long, also not have any inflation for this long. So will there be inflation? Looking at the budget deficits, there might be a high probability that would happen. If it does happen, inflation is okay if you're on equities, right? Because businesses typically can increase their prices, at least most of them can, and they can keep up with inflation. So I think for the equity market, it may not have, in terms of real returns, it might not affect those too much. So I don't think it should have a long-term impact. But if the interest rates, go up, if you look at S&P 500's PE ratio, I think it's around 35 or 40. I'll have to check, but it's pretty high. If you invert that ratio, you get the yield of the S&P 500, and that is roughly 2.5-3%. Now, think about it. You buy the index, you're getting 2.5-3%. You're taking all that risk, you get 3%. If you keep your money in the bank, I don't know what the rates are right now, but maybe you get 1% or something like that. If the Fed hikes interest rates a couple of percentage points, you keep your money in the bank, you get 2.5%. You invest in stocks, you get, or the index, you get 2.5%. Immediately, that makes no sense, right? So if the interest rates do hike, I think, and of course, nothing is for certain, but logically, stock market cannot stay where it is, So I think I'm more concerned about the interest rate. If that moves, this market could come to an end, this bull market.
All right, thank you.
I have a question. What advice would you give to investors such as the people on this call for finding undervalued stocks? Is there a certain method you use? Do you pay attention to any certain indicators such as volume during this process?
Yep. So I think the three indicators I mentioned, you can look at those, right? In addition, there's another indicator, which is, I don't personally use it too much, but I think could be useful, is how quickly do you get your cash from your customers, right? And that's a good indicator of how much do the customers love your product. And it's somewhat underutilized, but if you can look at that metric, like how quickly is this company getting cash from its customers, that will reveal that this company may be something special. And it should be better than their competition, right? Competition gets their money back in 100 days from their customers. These guys get it in 25, 30. They have superior bargaining power, or they have a superior product. That could be the case. So terms of trade, if you have superior terms of trade, that's great. PE could be sometimes something you can look at, PE ratio. And apart from that, you should look for, this is what Mr. Buffett and Mr. Munger used to do back in the day. They would look at every industry and go figure out who's the lowest cost producer. Because the cheapest guy, if you're selling something commoditized like paper, cement, or steel, these businesses tend to be cyclical. There's overcapacity, they go down, and there's, the prices come down. The high cost producers get eliminated. They can't keep up with the shrinking margins. But the lowest cost producers can typically survive. So I think if you want a good, maybe shortcut or hack, just try and figure out who's the lowest cost producer in this industry. And can I buy it at a price that makes sense? I think that's a good place to start.
Thank you.
Hello, I have a quick question. Am I better off in investing in ETFs and mutual funds or directly into a specific stock?
Well, I'd say it would depend on you, really. I mean, if you are a professional stock picker, if you wish to do it full time, and you can build a portfolio of about 10, 15 stocks, sufficiently diversified, you can invest on your own and do really well. But if you're not going to be doing it full time, then I think those are better alternatives, index ETFs. But still, I mean, you do need to have, even if you're investing in an index, you need to have emotional stability, because in our lifetime, in your lifetime, you can expect the market to go down by 30, 40, 50% multiple times. And so then your emotional stability will be tested, even if you own an index, right? Let's say the S&P 500. So either way, I think, for you, I would say, if you're looking to be a professional, maybe, it will take some time to put together a portfolio. If you can do that intelligently, you stand to gain a lot from that. If you're not going to be doing it full time, index is the way to go.
Great, thank you.
Just to piggyback off that question, do you suspect over the next 30 years, 10% gains in our 401k if we're invested in the S&P 500, such as 30 years prior?
Sorry, I missed the question. So let me repeat it. So do I expect 10% returns in an index moving forward?
Yes.
Well, from the current levels, right? So if you start investing right now, the yield is around 2.5%. If the interest rates come up, I think that just cannot be the case for very long. So I don't think it's going to happen. At least for the next decade, I don't think the returns are going to be there. I think if you're picking individual stocks next decade, I think, and if you do a decent job there, I think you'll do far better. But if you come in, after the, collapse or whatever that might happen, yeah, that could make sense. So your timing will make a difference somewhat. However, if you invested for the very long term, right, 20, 30, 50 years, I think you can expect 10%. But next decade, probably not.
Right. I guess that's what I was looking at, is 30 years down the road.
Yeah, I'd say I wouldn't expect 10. I would expect somewhere around maybe 9, 8 or 9, including reinvestment of dividends. I could be wrong on that, but yeah.
Thank you. Sorry about the audio issues.
No worries.
I just had another question. Oh, sorry. You can go. You can go first.
No, go ahead.
I just wanted to ask you how you went about starting your own hedge fund. Like, how did you go about starting your own business?
Well, so in my case, I've been investing for almost a decade now. And so I started with real estate, and, then I started investing in the stock markets. And, I'm very passionate about the markets, especially investing. I like the challenge of investing. So for me, it was sort of like a normal progression into investing full time, and also liked being in a business owner. I've run a few businesses of my own, and some were successful, some weren't, but I learned a lot running those businesses. And I would say it's been a long process. I don't know if that answers the question, but yeah.
Yeah, that makes sense. Thank you.
Just a follow-up question. You mentioned you usually aim for a 20% IRR. Does IronHold operate as a typical hedge fund where you guys are putting significant leverage to get that IRR, or is it something different? And understand if you maybe can't say exactly.
I mean, I can tell you, we don't use leverage, right? Because, anybody can get returns with leverage. You take on a lot of leverage, you get a lot of returns. When the market goes against you, you'll get wiped out completely. So again, thinking in bets, what's my upside and downside? You take a lot of leverage, huge upside, huge downside. Not a great investment strategy. So we don't use any leverage. Even in the businesses we invest, we demand that there's no, there will be some leverage. You want to have some amount of debt, right? Google makes, I don't know, I think something like billions of dollars. It won't make sense for them to have no debt. Right? They can service that much. So you want to have some, but if you're over levered, you are at risk at all times. So we try and avoid it. And I think my advice would be to avoid leverage. Because the thing is, as you saw with the returns, right? Even if you get 10% and you just keep investing for long term, and you can actually do better than, those numbers, $2,000. It's not exponentially high, I think. If you can get, 10% on your money and you don't lose money, over time, you'll do exceptionally well. So you don't have to, like in tennis, you don't have to play extraordinarily well. You just have to get the ball over. You don't want to make any unforced errors. And if you can just do that, you'll do well. So I don't see, and if you're skilled, you definitely don't need leverage. You'll just find opportunities through your own skill that will give you exceptional returns.
Thank you.
So you kind of came back to the 10% return there, and I'm 30 years old, so I'm a little older than everybody here. And I think the next decade, if we're not going to see 10%, would you suggest maybe entering into a managed position? Your thoughts?
I didn't get the last part. So would I recommend what?
Instead of just using my self-directed 401k, maybe investing in a managed mutual fund, or paying 2 or 3%.
Well, so I should say I'm not 100% sure if we will not get 10% moving forward, right? Macroeconomics is very hard to predict. I don't think it will happen, probably. But most likely it just won't be the case. I wouldn't say it'd be a bad idea. I think you would have to pick a good manager, though, right? You'll have to do a lot of due diligence, and you can look at track record, right? Their performance, and do they have a strategy that they stick to during the good and the bad times? And just those two things will eliminate a whole bunch of mutual funds, and that's sort of how you can go about it. And then your own appetite for volatility, because if the market goes down a lot in the short run, sometimes people get, they just can't handle it. So then you'd be advised to seek something that is low volatility. Though I'd say volatility is not very meaningful, but yeah, if that is not something that you like, volatility, then you can seek those. So it won't be a bad idea, I would say. Yeah.
Thank you.
I'm curious to know what kind of internal factors you look at a company where maybe they don't reach your intended percent gain or a price target. What kind of factors alert you when you realize maybe you should reduce a position or eliminate it completely?
Well, so permanently the business has to change, right? Thinking of yourself as a business owner is very important, right? So if I own Amazon, the stock goes down by 30-40% because there's something, maybe during COVID, it didn't fall by 30-40%, but a lot of these companies did. Like Lear Corporation got cut in half. Now you have to ask yourself, is the business cut in half permanently, right? Are they going to make half the money that they were making, right, or less moving forward permanently? The answer was an obvious no, right? If you look at the average company, even if you assume it's going to only last 10 years, right, Lear Corporation, what happens in one quarter? 10 years is 40 quarters, right? What happens in one quarter is 1 by 40. Even if the company doesn't grow at all, that's a minuscule percentage of a company's value. Even if you look at 4 quarters, right, the entire year, they lost money or didn't make any, that's still 10%, right? Assuming the company is not growing at all, 0% growth. If it's growing, then it's even smaller because the pie is getting bigger, right? So what happens in even 1 year or even 2 years sometimes, doesn't have much of an effect over the intrinsic value, because intrinsic value is what it will produce over 10, 15 years, however long the company is going to be around. So yes, Lear could lose a lot of money one quarter, but it just wouldn't make a dent on the intrinsic value. So the question I would ask is, moving forward over the next 3-4 years, is this company going to not do well? Like, has fundamentally something changed? Is there more competition now? Is this likely to persist forever? Like newspaper companies, probably wouldn't be an investor in those because they are permanently challenged by online newspaper magazines. So that business model is losing value. It's like a melting ice cube. You don't want to be, the ways to profit off it. But if that goes down by 40%, I just won't be comfortable because it's permanently a terrible business. Something happens to Amazon or Facebook in the short run, it's just a great opportunity to buy it for cheap.
So would you say it's more of a reactive approach that you take where maybe some event occurs and then you reevaluate your position and then make a decision for the future?
Well, so investing is more like, I would say it's like a hobby, really. It's like hanging out at the beach. You don't want to do too much because the more you do, typically the less money you make. You want to make the right decision and you sit back and you relax. Because if you change your mind every day, the company's not changing every day, right? Amazon's not coming out with new products. No new competitors are coming in every day. So it's like that. You want to be, once you've made the decision, you know your story, right? I think this company is going to do well because this product line is going to do well. They are an oligopoly, don't have any meaningful competition. Yeah, if that changes, and that will take time, right? If you own Coca-Cola, how long will it take a new entrant to come in and take Coca-Cola's market share? I don't think anything less than 10 years is a reasonable estimate. Because think about it, they've got thousands of bottling plants. They have presence in every country. They have a huge brand they built up over. Coca-Cola was, I think, founded in 1883. So 150 years worth of branding and presence and relationships with their suppliers. Will that be disrupted tomorrow? Not possible. So you just have to be, once you make the decision, you just keep checking it, but it shouldn't be too affected.
That makes great sense. And I really like the beach analogy. So thank you. I appreciate it.
Mm-hmm.
Well, if
All right.
nobody else is going to go, I have a question.
Sure.
Would you do it all over again? Is this your dream job?
Yep, I would say that. Extremely lucky to be in this position. So absolutely no complaints here.
All right. I don't think anybody else has any other questions. So thank you again. We really appreciate you coming in. It's really awesome.
Well, thank you for inviting me, Andrew. And yep. And thank you, Professor, for joining us as well.
Absolutely. This was wonderful. We really appreciate it. We'd like you to come back, maybe sometime next year.
It would be my pleasure. Thank you.
Yeah, absolutely. Thank you very much for this.
Take care.
Have a good one.
Thank you.
Thank you.